In with some announcements. The final homework assignment for the semester is due on Thursday before class. That's the one having to do with cost estimation. That assignment's been posted for a little while since it covers the techniques that we were talking about 2 weeks ago and even before. So you've got a couple more days to work on that. And I promised you that we would have one more quiz this semester, and it's not today, so you can draw your own conclusions on when it might be. By the way, Thursday is our last class. So, all right. Today we're going to talk about depreciation, which is a topic that comes from Chapter 16. Are there any announcement-related questions before we get into that new material? Okay. Well, we've talked about this phenomena before, that when you drive a car off the lot of the dealer, that it immediately loses a lot of value because it's no longer a new car, it's a used car. And there's just a whole different set of expectations and a mindset with that. And that concept of things losing value over time is called depreciation. And it's not just because of theoretical differences, you know, like a car that literally only has one additional mile on it. It's essentially the same car as it was when it was on the dealer's lot. But there are normal and more real decreases in value and usability of equipment over time, and we can quantify that through keeping track of depreciation. Now, depreciation has a lot of tax consequences, and that's most of the reason why we consider it in this separate way. We've already accounted for the decrease in value of equipment when we've considered, for instance, the first cost versus the salvage value. And so that's one way that we've addressed depreciation so far in the semester. But what we're going to look at today is how this loss of value in equipment can be an advantage to a business where they can reduce the income tax that they have payable because of the depreciation. Now, a couple of important terminology items that come into play when you're calculating the tax depreciation. The amount that is paid to put an item into service is known as the cost basis. And so the cost basis isn't just the purchase price, but it's also any sort of delivery, installation, or training costs that may exist in order to start using a piece of equipment. At any particular time, you can calculate the book value, and that's the value of an item in a certain year. And here where it's saying BV with a subscript of K, K is referring to a certain year or a period. And so the book value at an end of year, maybe end of year 3, end of year 4. And so over time, what we need is a method to calculate what is the book value of the equipment, because the depreciation is the difference between the cost basis and the book value. And so it's how much you paid to get the item in service, installed, and operational versus what it's worth now. And the difference between those two things is a tax deduction. Now, not everything can be depreciated. Certain property or purchases by a business can't be counted towards depreciation. And so, for instance, an item has to be used to produce income before it can be depreciable. And so if you buy meals at a restaurant, that wouldn't meet the criteria because it's a personal expense and it's just, you know, for your own consumption. It's not necessarily to produce income. The other factor here is that it has to have a useful life longer than a year. And so it's intended that depreciation is applied towards equipment and not towards consumable supplies. Things that are purchased with the intention of using up, like copy paper, you can't depreciate copy paper because it's not equipment. It's purchased with the intention that it's going to be used in a very short period. To depreciate, equipment has to be something that can wear out. It can't be a permanent purchase like real estate. Couldn't be depreciable because it doesn't lose value. It's durable. It will last over time. And also inventory can't count for depreciation. And so when you drive past a car dealer, although that equipment would meet all of these other criteria, like a car is going to be used to produce income, it has a useful life longer than a year, it does wear out, a business can't count depreciation towards their inventory. So remember, the key idea to continue to reflect on is the fact that businesses want to maximize depreciation, because when it comes to accounting, the more value that they can show has been lost on the equipment that they purchased, the bigger their tax deduction. And what we know is that a dollar now is more valuable than a dollar in the future. So the other thing that businesses are trying to do is they're trying to accelerate their depreciation. They're trying to get as much of it as possible early in the lifespan of equipment. And so if a piece of equipment is going to last for 20 years, then they'd rather have more of the depreciation early than the same amount of depreciation every year during that 20-year period. Because by the end of 20 years, whatever the depreciation amount is going to have very little value because of the effects of inflation. Any questions so far? Okay, the simplest way to calculate depreciation is just to assume that there's a fixed amount every year that the equipment loses in value. So straight line depreciation assumes a linear decrease in value during the item's useful life. So you have a starting basis, a salvage value, and the depreciation amount is equal every year. Declining balance, on the other hand, instead of having an equal amount of depreciation every year, declining balance says, let's have an equal fraction. And so maybe in declining balance, instead of saying the equipment decreases in value $200 every year, $200 that is, the declining balance would have it decrease a certain percentage every year. Now you can use a salvage value in declining balance, but it's not necessary. A blend between the two is the MACRS, and this depreciation method is much easier than straight line and declining balance because it doesn't require you to do the same level of calculations. It's just there's a fixed percentage of depreciation for each of the year of the useful life. And you can go to a pre-formatted table to look up what fraction of the value depreciates during each year. And in this system, there's no salvage value. It's assumed that the equipment goes down to zero value during its useful life, even if in reality it has some salvage value. For tax purposes and for accounting purposes, when we use this system, all of the value of the item is depreciated during the period. So we're going to do some in-class exercises today that touch on all three of these different techniques. So remember, here is the applicable terminology. I think we've addressed all of these in previous slides. Now, what's going to be new, though, is the idea that we may have a fraction, a certain percentage of the value that depreciates over time. The depreciation rate will be specified in problem statements where you have declining balance. So in a declining balance problem, they're going to tell you a certain percentage of depreciation. And I'll show you in an illustration what that means. Remember that the personal property, corporations are often considered the same, equivalent as people. You've probably heard of incorporation or corporation, and the Latin root of that is body. And so there's a principle in American law that companies can be treated as people, and that's why in a recent Supreme Court decision it was decided that companies can spend money on elections because it was equated to free speech, and so they're taxed like people. And so those possessions, the personal possessions of a company that conduct business, are the ones that can be depreciated, but real property can't be depreciated for the reasons that we talked about, for instance, that it's too durable. It doesn't wear out. In the MACRS depreciation system, there's something called the half-year convention. And it's kind of closing a loophole that could exist if you're a company and you buy equipment on December 31st. And the reason why a company would do that is, remember that they're always trying to maximize depreciation and get it as early as possible. And so if a company bought an item on the last day of the year and then they took a big fraction of depreciation during that year when they only owned it for a single day during that calendar year, then it would kind of be a loophole that the government wouldn't want to tolerate. And so what they did is they introduced the half-year convention, which means in the first year of ownership, you only get a half share of depreciation, regardless of when you buy it. So we'll see the half-year convention in action in a minute when we get to the in-class exercise. So here's the formula for straight line depreciation, and this is the linear decrease where every year the same number of dollars is decreasing. And so just as an illustration, you can calculate the depreciation in every year with this formula. So it's telling you the amount that it's decreasing. And so it's the book value minus the salvage divided by the number of years. And so that's the starting price, the finishing price, and so the difference between the two is how much value was lost in total, and then N is the number of periods. And so then that gives you the amount of dollars lost each period due to depreciation. And so remember, the BV stands for book value, and it's the accounting value. It's not necessarily the market value of the item, because the market value is determined by what people are willing to pay for the item. The book value is more about, according to the accountant and the tax calculations, on paper, how much is the thing worth in any given year. And so what this says is you start with the initial starting price, the first cost, which includes the installation and training and all the expenses required to put the item into service. So you start with that, and then a certain number of years of depreciation per year would tell you the book value in that given year. All right, so that's the straight line depreciation. And just as an illustration, if you know a certain gas processor has an initial cost of $20,000, a salvage of $5,000, then what that allows us to know is that it's going to be $15,000 of depreciation in 5 years means it's $3,000 per year. And so the depreciation in year 3 is the same as the depreciation in all the other years. The depreciation is a constant $3,000 per year. So then if we want to use this other formula for the book value in year 3, you can do it a couple of different ways. You can find the book value at time 0, at time 1, at time 2, at time 3. So you could set it up like an Excel spreadsheet and row by row calculate the book value in each year. That's one method. Or by substituting into the formula, if we know that there's 3 years of depreciation and it's $3,000 per year, then it's a total of $11,000 of remaining book value at the end of year 3. So this is just an illustration of why they call it straight line depreciation, is it's a linear decrease in value, and that's not realistic. If you go into the, I guess it's not the want ads anymore, if you go to Craigslist and look up a used car, then what you'd find is that we have a nonlinear relationship. For some cars, the curve would decrease really quickly, like they lose a lot of value and then it flattens out. And some other cars will keep their value for a long time and then it just tapers really dramatically all at once. But it's nonlinear most of the time. So that's declining balance, where instead of a fixed amount each year, you have a fixed percentage. Now here are the formulas for declining balance. And in a problem statement for declining balance, they'll talk about the percentage depreciation. And so in the problem statement it'll say 150% or 200%. And what they're talking about when they mention that percentage is the slope of the line in the first year compared to straight line. And so remember, in straight line depreciation, it's going down towards some salvage value. In declining balance, in the first year, the decrease is going to be steeper than a straight line would be. And it's because of this percentage factor. And so you have to calculate the depreciation fraction by knowing the percentage that's mentioned in the problem statement. Or if a salvage value is described in the problem statement, then you'd calculate the depreciation factor directly based on the salvage value and the book value. And so there's one of the two problem types. Either it will be one where they say a salvage value, or it'll be one where a percentage is specified. And then once you have the depreciation factor, then the book value at any particular year can be calculated with this formula, where you'd have to use the years to the exponent. And so let me just illustrate with a specific case here. If you have a truck that costs $80,000 as the initial purchase price, and you know it's going to last 10 years, then the depreciation and the book value over time can be calculated. Okay, first of all is, what if we use 150%? And so what that means is that in the first year, the depreciation is 150% as much as it would be if it was straight line. So businesses like this. Businesses prefer declining balance because they get more of the depreciation sooner compared to straight line depreciation. So in 150%, you'll notice that first of all, here's the 150, and then we use this formula to calculate the D. And so 150 divided by 100 times 10, so the factor is 0.15. So the 0.15, what it means is that in each year, the book value is going to be 15% lower than it was the year above it. So 15% of 80,000 is 12,000. And so if 80,000 was the initial book value, then the depreciation in year one is 15% of that previous year's book value. So the depreciation is 12, which means the remaining book value is 68,000. Now 15% of 68,000 is 10,200. So then the remaining book value would be 68,000 minus 10,200, and then we have 57,800. And so you can see each year's depreciation is based on the book value of the previous year. So here at the bottom, this formula of the depreciation in any given year is the depreciation factor times the book value in the previous year. So that's pretty helpful if you're going to be solving it with a spreadsheet. Now it can also be solved just by equation methods, and so you have either approach available to you. That's 150%. What you'll notice is that this is never going to get to a certain salvage value. It's going to end at kind of an odd number. And so the declining balance, the depreciation keeps getting smaller and smaller every year, but since the dollars closer to the present are more valuable, that's kind of what a business prefers. In Part B, if you know that at the end it should reach a salvage value of 10,000, what you're doing is you're calculating what is the D factor that will get you to that known salvage value. So we know the starting point is 80,000, the finishing point should be 10,000, and so we're kind of interpolating the value each year between those points by calculating what's the depreciation fraction that will get us to exactly 10,000. Now a note about rounding off. I noticed in the quiz that some people were rounding off in the interior of the quiz. Like in the middle of the quiz, if you round off to 2 digits or 3 digits, then you're not able to report the final answer to anything more precise than how many digits you've rounded off to. And so when you're doing these depreciation calculations, if you calculate a D factor, you need to have all of the digits of precision remaining in your calculator so that you can be accurate to the nearest penny when you're calculating the book value. So get in the habit of not rounding off when you're doing calculations that you're trying to be accurate to the nearest penny. Okay, so we're going to start with the in-class exercise. We've got in Part 1 a straight line depreciation problem, and Part 2, which is on the back side of the paper, is a declining balance problem. So we're just going to do Part 1 and 2 and then go over the solution together, make sure that everyone got it correctly, and then we'll talk a little bit more about the MACRS method. Were there any leftover quiz 5 papers? If you want to check your answers so far, I've got the key up on the screen showing the depreciation in each year, the book value at year 3, and so on. So when a certain item depreciates down to 0 and doesn't have any more value, then the depreciation for that item is finished. And so, for instance, in year 8, the loader and the mixer aren't going to contribute to depreciation anymore because they've already gone to 0. There's no such thing as negative value. So it's only the crusher that has some depreciation in year 8.
Same with C.
That's right.
The mixer would go away, right?
Yep, the mixer has no more value. So what you can see is with the 150% declining balance approach, the depreciation amount keeps getting smaller every year. The first year's depreciation is the greatest, and then it just continually tapers off from there because each year's depreciation is a percentage of the previous year's book value. So the initial book value was $486,000, and so the depreciation during that first period is 18.75% of the previous year's book value. So you have to calculate the book value at the end of year 1 in order to calculate the depreciation amount during the second period. So it's a progressive calculation. And I've demonstrated 2 different ways to calculate the book value. I'm showing that you can use 1 minus the depreciation factor to the power of whatever year it's in. So for instance, during year 2, we could have calculated this book value by having the previous year's book value minus that year's depreciation. So in other words, $394,875 minus the $74,039 depreciation, you'd get the same book value of $320,000 by having the 394 minus the 74. So you can either just calculate the depreciation amount for each year and then get the book value with that dollar quantity, or you can calculate the book value by using this exponent approach. If you're solving with Excel, it might be simplest to set it up row by row by using the depreciation amount. So setting it up on Excel kind of makes the calculations go by pretty quick. We have some starting book value, then the depreciation amount in the next year is going to be the percentage of the previous year's book value. So if our starting value is $486,000, then the depreciation during the first period is 18.75% of that initial value. So then the book value will just be the previous book value minus that year's depreciation. And then the next year, depreciation is based on the previous year's book value, the fixed percentage. So the book value is just going to be previous year's book value minus this year's depreciation, and so on and so forth. And here's the answer for part B. If you do it by hand, or I'll show you if you use Excel in just a moment. So what you'll notice is that when we do part B, for where we're calculating the D in order to hit a known salvage value, that the only way we'll get to that salvage value by the penny is if we have calculated D to quite a lot of precision. So if we had rounded this off to just like 0.19, then we're not going to get the book value to what it needs to be. You know, we know the book value, the salvage value at the end should be 87,000, and so this has to be to quite a lot of digits in order to get that to the nearest penny, being 87,000. So the moral of the story is don't round off. Any questions about straight line or declining balance before we move on to the third approach? All right. Well, let's look at MACRS. It always depreciates to zero, which businesses like, because remember they're trying to maximize the tax deduction that they can take. And it switches from double declining balance to straight line depreciation. And so double declining balance means that it's a 200% declining balance during the first years. But then if you're having that percentage method, it never gets to a zero salvage value. It just keeps getting smaller and smaller depreciation each year. And so that's why it switches to straight line, is so that the item can eventually get down to zero value. And standardized recovery periods are used according to the type of equipment it is. And this is something that's familiar if you are acquainted with like commercial shipping, where the cost of shipping items partly depends on the distance and the weight, but it also depends on what it is you're shipping. For instance, when I was in graduate school, I needed to ship some equipment from Canada to Indiana, which is where I was in graduate school. And it was water treatment equipment that used ultraviolet radiation to disinfect the drinking water. And based on how big it was and how heavy it was going to cost about $3,000 to ship the item if we called it research equipment. But if we called it water purification equipment, it was only going to cost about $1,500. And so it was half the price depending on whether we called it research equipment or water treatment equipment. So, you know, sometimes getting the exact right classification is pretty important. So in this case, the depreciation depends partly on the classification of the item, and I'll show you in a minute the tables that are available. We've talked about the half-year convention, and because of that, the MACRS method, if an item is anticipated to last, for instance, for 7 years, then that means depreciation is taken out during 8 years, because you have a half share of depreciation in the first period and then the half share of depreciation in the last period. So they kind of are trying to reduce the incentive for playing games with when you buy the equipment. Now here's the table that we consult depending on trying to find out what the recovery period is, and we're going to use GDS for our recovery periods. And you can see that depending on the equipment, there are standardized assumptions on how long the item is going to last. So the class life, you can think of that as on average how long the equipment is going to be durable. But then the recovery period in most cases is less than the class life. In some cases it's longer if it's unusually short class life. And once you know what the recovery period is, then these are the tables that you'd use to find out the depreciation fraction for each given year. Now for each of these columns, if you add up all of the fractions, it adds up to 1. And the reason for that is, remember, we expect that all of the items' value will be lost when we use the MACRS method. In other words, there's no salvage life. But for a 3-year depreciation, it's spread out over 4 years because there's a half share of depreciation in the first and a half share of depreciation in the last year. And so they try and have it start off at double declining balance, which means 200% of the straight line, and then it switches over to straight line about halfway through. Now these are the formulas that you can use if you want to find the depreciation amount in any given year. It's just going to be the fraction multiplied by the first cost, and the fractions are known, so you don't have to calculate them, which makes that pretty easy. And then the book value in any year, you can only calculate the book value by adding up all of the previous year's depreciation. And so it's the starting book value or cost basis minus the cumulative depreciation to date. All right, so on the in-class exercise, on the third page that you've got on the paper there, we start off with a description of the statement. It's a bus where you spent $238,000 to purchase a bus, and the important thing about it's a bus is that'll tell you which category to use for the recovery period. And then what we'd like to know is what is going to be the depreciation in the book value for each year. So if it's purchased in 2018, how much depreciation do you get in 2018? And what's the book value at the end of that year? And then what's the depreciation in book value for each subsequent year? So since it's a bust, that means it's going to have a 5-year recovery period. And then when they say 5-year recovery period, of course what they really mean is 6 years. I don't know why they just don't call it a 6-year recovery period, but you know the backstory about the half-year convention. So during a 6-year period is when the book value goes from the initial purchase price down to 0. And I've got the amounts shown on the screen.